Right now is Daniel Frischberg. He's Chief Investment Strategist at Laffer Frischberg, and Mark Degennaro, Managing Director at Gruppo, Levey and Company. Nice to have you on the program.
Thanks.
Welcome. Mark, let me kick this up with you. The economic crisis has certainly created the survival of the fittest environments here. You're a restructuring expert. What do companies need to do in this environment to survive and perhaps thrive?
Well, the first thing they need to do is they need to be extremely proactive. You can't sit and hope that times will get better. In the short term, they're not going to. So you need to be very proactive. You need to have a manageable capital structure. You need to have a management team who can really weather the storm. You have to have a very efficient cost of doing business or efficient operating structure in your business. And you have to have a vision for where you're going to take the business beyond the next couple of years.
Oh, Daniel, has Ford been able to do that? Do you think Ford is an example of this that has really differentiated itself?
No, actually, what I think they've done is they've done the one thing he didn't mention, which was we're developing this pattern that the less you have to do with the government, the less you get involved, take money and supervision from them, the better you're doing. There's an inverse relationship. And I think right now that's what Ford's doing right.
So that's an interesting point. You don't want to be, so from an investment standpoint, do you want to be staying away from companies that are too regulated?
Absolutely, I do think you want to keep away from companies that are too regulated.
Do you agree with that, Mark, in terms of what Ford has been able to do, just not take any government money and go it alone?
I agree to some extent. Let me put it this way. I think Ford is in a position where it didn't have to take any government money.
Right.
It was ahead of the curve in terms of technology. It actually proactively negotiated with a number of constituencies. It negotiated with the UAW. It negotiated with respect to the health care benefits. It established, as you know, a trust. It funded it with 50% equity. It made a tender offer to reduce its outstanding indebtedness by a third. So all of those things have put Ford in a position where it does not need to rely on government financing.
Yeah, I think he's actually reading it backwards. It's a good point, but what Ford was doing was minding their store instead of looking to the government for that kind of help. And that's probably would have worked for any of those companies to negotiate.
It's really, would it have worked for AIG?
No, because AIG's problem wasn't the high cost of labor. There were different problems with the AIG. But for the car companies, that's very important. Ford said, we're going to notice that the car unions took half the money that Ford owed them in stock. Right. While the General Motors and Chrysler were looking to the government for handouts, the government was beholden to the unions, and so their hands were tied, and they're finding their way into bankruptcy.
Mark, what do you say about that?
Well, I'd like to. I think those points are very well taken. I think at the end of the day, the first point that was made earlier, which is you don't want to have to deal with and borrow money from the government if you don't have to, and there are lots of ways to not have to do that. But it goes back to my earlier point. You really need to, whether you're a large multinational corporation or a mom and pop store on Main Street, you need to be very proactive. You need to delever. You need to basically run your business in a way where you can survive to fight another day.
Now, you have an investment strategy built around this. You say that Goldman Sachs and Bank of America will be great investments going forward. BofA took money from the government.
Well, yeah, but less, and of course, look, I own Goldman Sachs. I own Bank of America. That is correct. But remember when probably in the middle of the winter, I told you around the spring we'll be buying stocks. And so what we were buying was the most beat up stocks. Now we're talking to investors who are watching what's going on. The industries that have had to take government money, the ones who've been forced into that, are in industries where the average investor probably shouldn't be looking to allocate his money. Why not go to the ones who have a clear sailing? They're companies that are really doing businesses that are profitable. They're not in trouble. They're not having capital problems. That's what attracted the government, like a piece of candy on the floor of your garage attracts the ants.
Yeah, no, I know, but I mean, Bank of America acquired Merrill Lynch and had massive losses as a result.
Yes, but they also, and look, they're going to have to go through that little tabloid story. I don't know the answer to that one, but I do know this.
Well, it's more than a tabloid story. It's $15 billion in losses in a 3-month period.
No, I know that, but the question is, did the CEO really have to do the right thing, or should he have been the CEO? CEOs fall on their sword before they give up their company.
Right.
He told me I have to. That's what the Nazis said, right? That's not really the way CEOs are supposed to behave. That's why you get paid that big bucks,
right,
to stand there and defend your company,
so
not do the right thing.
So as a shareholder, you're upset about this?
Yeah, do the right thing with your money, not with my money.
Right.
Protect the stock with. That's what your job is.
Right.
Look, I'm a CEO. I have to do the same thing.
But you still think that this is a good investment?
Well, I do, but not because of Lewis. I think it's a good investment because they acquired a mortgage company. They're in a position where they can borrow money almost for free. Mortgage rates, corporate rates, everything is much higher. They've got a great spread, and they got a mortgage company that's now going to get all the support in the world to issue profitable mortgages. It's a good business, and they're getting assistance.
Mark, but you do have government intervention to think about. How does that change the game in terms of survival of the fittest?
Well, the question, I think, ultimately is what happens when the government intervention is no longer there. The government intervention is supposed to be a short-term mechanism to be able to prop some of these institutions up so they can clean up their balance sheets and they can survive in some form in the future. One of the things that is still not really being addressed, we've seen all the regulations, we've seen all the programs coming out of the Treasury, but we've still got this problem where we've got these toxic assets still plugging up the system. They're still on the balance sheet of these major financial institutions. We have to deal with that.
One of the sectors to look at, certainly in terms of distress right now, is retail. What do you think there?
Well, look, retail is what they're doing is they were so bad because we had a period there where we thought everything's going to go to zero. So now what they're doing is they're racing up to the downward sloping trend line. They're going, but they're not really having any kind of a real future where they're going to make a lot of money. But you know, for your whole time, for the 20 years you've been in business here, every day somebody comes and tells you this is a stock picker's market.
Right.
We haven't had a stock picker's market in 35 years, Maria. But now we're going to have one because we don't have an indexer's market. You don't have the economy getting better. The stock market's not really going to go up. Companies, industries, and countries who are in the right place at the right time are going to be good investments.
Yep.
Now you're going to have to select who's doing a good job.
Absolutely. Yeah, it's an important point because we actually have had an area where the market has been going up and you could have actually bought an index and been fine.
Well, worse, they have books about buy the worst stock on the Dow. I mean, they've got everything works.
Mark, how do you differentiate yourself in retail right now?
It's really tough. There's way too much supply for the foreseeable demand. I think if you're a retailer, you have to have products that are quasi-proprietary products that other people don't have. They have to be competitively priced. And I think, you know, quite frankly, you look at the retail shakeout, and I think we will see more store closings. We'll see more companies going into bankruptcy. At the same time, that's going to provide some consolidation. I think some of the stronger businesses are going to survive, and a few years down the road, we'll have less retailers, but probably stronger retailers.
All right, we'll leave it there. Gentlemen, good to have you on the program. Thanks
very
much. Mark Degennaro, Daniel Fishberg, always nice to see you. Thanks very much. Scott, over to you.
Okay, Maria, about 20 minutes to go.